Hey guys, welcome back to my YouTube channel. I don't typically do this, but I'm so excited to bring on Joseph Puckett today. I've been watching his YouTube videos for a while now, and I really enjoy what he does, as in he's just sharing what he does. Like he's 100% transparent on his trades, and it's great to see. He started off as a 112 trader, which I know a lot of you guys on here are, but then he also transitioned more into ratio spreads, and I can't wait for him to talk about that. So first off, Joseph, just welcome and thank you for being here. But what would you like to share about your trading journey and stuff, I guess?
Awesome. Thanks, Austin, man. I appreciate it. I've been watching your videos and your content as well, and I'm excited, to just share what I can with your audience. I have to start by saying this. This is not financial advice. Don't do what I'm doing. I'm crazy, y'all. I'm crazy. In fact, when you look at some of my positions, you might be like thinking, yeah, he's freaking crazy. There are so many ways to trade, so many ways to make money in the markets. And, I started in 2020, like a lot of people during the pandemic. I had a great job, but I wanted more. I wanted more for myself. So I was like, you know what? I want to start investing. So I started investing by buying Apple shares. I thought, I like Apple. Everything I got is Apple. I got multiple iPhones. I got multiple Macs. I got everything, right? The iPads, Apple Watch. I was like, you know what? I'm going to buy some Apple stock. So I did. And then I learned about covered calls. So I started selling covered calls against Apple stock. I started my account with like $20,000, and then I was adding more every month with every paycheck. I haven't added to my account in, I don't know, a year and a half, almost, something like that. It's just been, profits. But I started wheeling Apple, and I had a lot of success. Why? Well, after the COVID crash, everything went straight up, right?
Mm-hmm.
And I was like, shit, this is easy. This is too easy, man. I'm printing money. I was texting my wife, being like, baby, I'm going to quit my job. I'm going to quit my job. I only have $50,000 to my name, but I think I can do this. No, I had to save more, invest more, learn more. I switched to wheeling the TQQQ, triple Qs. It's a triple leveraged NASDAQ ETF. This was back in 2021. I had a lot of success. What happened in 2022? The NASDAQ went down, 30 something percent, something like that, from January 1st to December 31st. Oh my God, 2022 sucked. And I thank goodness that I got out of my TQQQ wheel. Like I had TQQQ ETF shares at like 120 something, like average price. TQQQ got down to like $16. Like if I had held that position, I would have lost like 80% of my account. So I thank goodness that I got out of that. So I kept learning, and I kept searching online, and I love YouTube. And I found so many people on YouTube talking about selling options. And that led me to Tastytrade's YouTube channel. And man, I learned so much from Mike and his whiteboard, from, the Dr. What's his name and all of his options basics videos, watching the live streams, the Tasty live streams. I was like, you know what? These people are onto something here. What's really cool about selling options is when we sell options, we can be wrong and still make money. Versus if I were to say, you know what, I think the stock market's going to go up. I'm going to buy, X amount of number or dollar amount of SPY, SPY, S&P 500, or the Qs, triple Qs for NASDAQ. I'm just going to put all my money in and hope that it goes up. That's fine too. And honestly, that's what most people should just do, is just invest in something like the SPY, the S&P 500, and just put money in every week or every 2 weeks or every month, consistently dollar cost averaging in. Honestly, if I would have done that over the past 4 years that I've been trading, hell, I'd probably be about the same place where I'm at now. Maybe even better. So long story short, I found Tastytrade and their videos about selling premium. I was like, okay, this is interesting. It's all based on probabilities, right? If you buy a stock or an ETF, it's a 50-50 chance. It's either going to go up or go down. But let's say I'm bullish on something. I think it's going to go up. Well, I could just sell a put on it further out of the money, give myself a 70, 80, 90% chance of profit, even if I'm wrong, even if the asset goes down against me. But if it never breaches my short strike on the short put that I sold, I keep all that premium, assuming I held it to expiration. How amazing is that? So basically, instead of being a gambler, which most traders are, and trust me, I am too. I'm a degenerate. I trade too big. I do. I trade way too freaking big. And it's killed me for the past 2 years, a year and a half, really. It's really hurt me. I've made really great money, but then I've lost it all and then some. And then I've made really great money and then I've lost it all and then some. And I'm really having to teach myself or to train myself to stop trading so damn big, to stop trading actual futures contracts because I love to do it. I've made a ton of money doing it, but then I lost it all and then some in April when the market had a huge sell off in April 2024. So, long story short, to summarize, I've only been doing this for about 4 years. I've only felt really good about my strategies for about the past year. My biggest problem is I keep getting in my own way. I keep getting in my own way and trading too big and buying too many futures thinking I know it's going to go up. And then we have a 5% sell off or a 10% sell off and I lose tens of thousands of dollars. It's really, really frustrating. But keeping going. I learned a ton from Tasty. I learned a ton from other YouTubers. And then I found Tom King of Income Navigators. You know, Tom King and Igor of Income Navigators, they're really the only paid Discord that I would ever endorse. I learned so much from Tom King's videos, and I'm so thankful for him. I met him. We talked on the phone. We talked via Zoom. I was a part of their community for a couple months, and I decided I want to do my own thing. But I kind of wish I just stayed in their community because I think it would have helped hold myself more accountable to not being a degenerate trader like I became. So I made over $400,000 in about 4 months this year. And then in 1 week, I gave all that money back to the market. All of that money back to the market. Why? Not because I was selling 112s or put ratio spreads. It was because I was actively trading large size of contracts. I was making $5, $10, $15, $20,000 a day. I had 95% winning days in a row for like 2 months. Like I barely lost. But then I got in at the high of mid-April 2024 with a pretty large size. And then I added in for 2 or 3 days. And I watched it go down for the whole week. All of my gains for the year were erased in 1 week. And I'm just thankful. I thank goodness that I was able to start again on April 22nd of this year. Since then, I'm up 65 grand in the past just over 3 months. That's about $20,000 a month. I was up more, but then I dug myself a hole a couple weeks ago as we've had a 10% sell off in the NASDAQ. I'm thankful, though, that I was not nearly as big as I would have been. And I was able to lock in and protect a lot of my gains. And I'm trading much smaller. I'm sticking to my trade plan. What it all boils down to is capital management and capital preservation and risk management. I suck at all of those things. So I have my Discord, the Trade with Joseph Discord. It's now free. There's no charge or anything like that. I just want to build a community of traders. Honestly, the main reason I'm still keeping it going and I'm still posting every day and every week is to help keep myself in check. If I know there's 642 people, whatever there are members in that, if I know there's a couple thousand followers on my YouTube that are watching my infrequent YouTube videos, I'm not posting as much on YouTube anymore because honestly, I don't make a lot of money on YouTube and I get to do what I want, right? I choose what I'll do with my time. But if I know people are watching me in the Discord, if I know people watching me on the YouTube, I feel like it's helping hold myself accountable to not being a dumbass. So hashtag don't be a dumbass. That's what I would say JP would be if I didn't know there were hundreds of people watching me. You know, futures are amazing. I'm so glad that I moved on from wheeling individual stocks to then wheeling the T triple Qs, and thank goodness I got out at like $80 or $90 a share. My cost base was like 120. I was thinking, this is the end of the world. I suck as a trader. And then it went all the way down to $16 a share. I was like, you know what? I'm glad I got out. I think thankful I did that. But then I found futures and selling options on futures and learning from Tom King and Igor and others on the YouTubes about selling options on futures. That's when the light bulb really clicked. The light bulb really clicked for me. So long story short, in the past 10 minutes, I don't know if I've really said much at all, except I'm still a work in progress. I'm still learning. I'm still soaking up as much as I can from YouTube University, right? All the other YouTubers out there that I'm trying to learn from and see what they're trying, see what is tested and proven, but also see what they're testing, right? They might be in the testing phase on something. So it led me to the 112 trade, which I know a lot of your followers like to do. That's the main trade that is taught by Mr. King and others out there. I love the 1-1-2 trade. What I learned though, or what I feel like over time, is I started to move more towards just pure ratio spreads like 1/3 or 1/4 put ratio spreads. I got into a debate or a conversation, I should say, not a debate or an argument. It was a conversation with a Trade with Joseph Discord member. He was like, Joseph, your 1/3 ratio spreads, they're dangerous. I prefer 1-1-2s. I was like, all right, tell me more. Well, there's only 2 naked puts. I was like, all right, follow me here. A 1/3, so 1 long put by 3 short puts, no matter if they're at different strikes or the same strike, which is what I prefer. I prefer 1 long put closer to where the market's currently trading, and then 3 or more further out of the money puts. Guess what? There's only 2 naked puts there. He was like, oh, okay, I get it now. So it seems more dangerous, but it's really not. The only reason I prefer pure ratio spreads, like a 1/3 or more put ratio spread instead of a 1-1-2, is it makes a beautiful potential max profit tint that's huge versus a 1-1-2 type trade, or like a 2-2-1 or a 4-4-1, which is like a hedge type trade. It caps the potential upside. If we have a huge down move, it's capped like this. Why I prefer my ratio spreads is there's a much larger potential profit tint. So
yeah, I mean, that's what I initially learned from you when you were into 1-1-2s. You would turn your 1-1-2 into a ratio hedge by closing the short put of the put debit spread. And I was like, oh my gosh, that's a great idea. You just see that curve. You have especially if you're trading ES, it's like a $20,000 to $30,000 profit in that max zone. And so I definitely see the appeal to wanting to do the ratio spreads. But I guess my question is just to clarify. So you went from 1-1-2s and then to ratio spreads, and how does your game plan differ between those?
Well, what it boils down to is probability of profit. They both have similar probability of profit. They both bring in similar initial credits. They both use similar buying powers. But what I like is that potential profit hump in the ratio spread tint, the pure ratio spread tint, without a 1-1 here, just a 1 and then 3 or more way further out. So that's how I evolved. And trust me, I am still a work in progress. When it comes to my trading strategies and things that I'm still evolving and learning and growing and doing, you know what I've learned? The less I mess with it, the better off I am. So sticking with a strategy, a lot of people strategy hop. They try this. Oh my gosh, this is the silver bullet. This is the magic bullet, whatever. This is what's going to make me a millionaire and I can quit my job. And then the first time that it fails or hurts them, shit, this sucks. I'm moving on. I'm going to find another. And that's kind of what I've done over the past few years. I've tried different things. I've chased the shiny objects. I've chased the pretty things where I think I can win. What I'm trying to do now is stick with my plan, stick with my trade, stick with my strategies. There's so many ways to make money in the markets. There's some people who think I'm crazy. I was going back and forth with an email exchange with a Trade with Joseph member. He was like, I'm afraid to put this in the Discord. I just wanted to email you. I was like, that's cool, man. He's like, man, I just don't know. I just don't know if I could ever do this. I don't like the nakedness. I don't like, the unlimited potential loss. I was like, dude, just do credit spreads. Not that I'm giving financial advice. I'm not giving financial advice, but just do defined risk credit spreads. And I went through a stint in May where I was basically defining the risk of all of my ratio spreads. I turned them into what I call broken wing butterflies on steroids. So not just a 1-2-1, which is what a typical broken wing butterfly. I would do like a 1-3-2, still defined risk, but I would get a lot more potential credit in the middle. I was like, man, just do credit spreads. Put credit spreads are probably the safest strategy that most people could do. Yes, they can lose money. What I found, though, is the more naked I am, the more profit I make over time. So that's why I'm still comfortable being more naked. So that's kind of how I've evolved from the 1-1-2 to now 1/3 or even more put ratio spreads to give myself the chance for potentially more profit in a 5, 10, 15% down move, but basically the same tail credit if we just go up, up, up. Now, here's another thing I've evolved. I've also started selling more on the call side. The call side on equities scares me, right? It does. because equity markets tend to go up over time. S&P, NASDAQ, even Russell. Russell's been kind of flat to down for a while, but man, Russell's broken out over the past 2 weeks, right? 10% in 2 weeks is insane. Like literally 1% every day for 10 trading days. Russell has freaking broken out, right? But most equity markets go up over time. So fighting the upside is kind of a challenge for me, but I'm glad that I have some on today. NASDAQ is down 1% today. S&P is down 0.5% today. I don't track Russell in my watch list because I don't trade it. My accounts are down about 1% today, a little under 1% today. So I'm still tracking with the market. But I have much higher probability of profit because I'm selling options instead of just buying a stock or an ETF and hoping that it goes up. But that's another thing that I've done to evolve is I've started to sell some on the call side. But like on my NASDAQ trades, you'll see 2 to 3 or more put trades than call. Now, on commodities like gold, bonds, and crude oil, I feel more comfortable doing both sides of those markets, call side and put side, because those tend to trade in ranges, but they can certainly break out up or down. They certainly can. And boy, can they move. So I want to be very careful with commodities because they won't necessarily go up over time. I mean, from 2010 through 2020, gold lost 50% of its value slowly but surely over that freaking decade. Over that decade, gold was at like 2000 and it got to like 1000 by like 2020 or whatever. I'm just coming up with these numbers from the top of my head, but I know it lost about 50% over 10 years. I do not think, and I have to do some research, I do not think there's ever been a 10-year stretch of an equity market losing 50%. I can almost guarantee that's never happened. Over a 10-year period where like the S&P 500 lost half of its market value, I can almost guarantee that's never happened. I bet every 10-year period, no matter what year you start from and end from, the equity markets have ended higher. We did have the lost decade from 2000 to 2010 where we dipped about 40% or so, but then we rallied. So over that 10-year period, we were flat, right? We were flat, but that is so rare. That is so rare. Most of the time, equities go up. So I want to be very careful selling call side ratio spreads, which I'm doing now on NASDAQ. It's helped me over the past couple of weeks. NASDAQ's down over 10% in the past 2 weeks. So I'm thankful that I had some call side stuff on. If I didn't have any call side stuff on, my accounts would be a little bit smaller than they are today. But I want to be very careful not to go too big on the call side because naked calls scare me way more than naked puts. I don't know why. It's the same risk. It's the same thing. But I just feel like I'm okay if the markets come down a little because I feel like they will revert higher versus if they're going up, they can go to the freaking moon and there's nothing I can do about it. And if I still have those naked calls on, that does scare me. But I do have some naked call ratio spreads on NASDAQ, and I have pretty balanced double ratio spreads on bonds, gold, and crude oil. That's what I call the double ratio spread, or I call it the strangle on steroids. So it's not just a strangle, selling short puts, selling short calls. I have some long options in there with more, 3, 4, 5 more short options on either side. And it gives me a nice, beautiful profit humps on either the call side or the put side. So I've evolved to doing strangles. And then I've evolved to doing double ratio spreads, ratio spread on the puts, ratio spread on calls. It gives me nice, beautiful potential profit humps on either end, what I call strangle on steroids. Other people call it the Batman trade. So that's something else that I'm doing now on commodities. The beautiful thing about selling calls on commodities is calls are typically priced about the same as puts. That is not the case on equities. If I looked at the NASDAQ, like a 10 delta call versus a 10 delta put, the 10 delta put will have way more premium than the 10 delta call, even though it has the same risk or the same probability. So there's a lot of put skew in equity markets. What I found in commodity markets is there's not a lot of skew either way to calls or puts. They're priced about the same. So that's why I'm okay or more comfortable selling strangles or double ratio spreads on commodities like bonds, gold, and crude oil versus matching the same number of short calls and call ratio spreads on NASDAQ, for example, to match my NASDAQ put ratio spreads. So I hope that answers your question, how I've evolved. Oh, I also love the wheel. I love wheeling futures. I do. Wheeling futures. A lot of people think you can't wheel futures. Yes, you can. Stocks and ETFs don't have expiration dates, right? SPY doesn't have an expiration date. Yes, the options on SPY have an expiration date. But if I just bought 100 shares of SPY today and never did anything to it, if I looked at my account in 30 years, shit, that would be worth a ton of money, like a lot of money, right? But it doesn't expire. If I buy a future on the S&P, that expires every 3 months. All right, so I'd have to roll it. I'd have to close the current open one and open a new one if I want to. So a lot of people think you can't wheel futures, but you can. I have really enjoyed wheeling gold in my IRA and in my main account, wheeling the micro ES in all of my accounts. I'm now currently wheeling the micro NASDAQ in my main account because I'm wanting to stay smaller, so I'm doing the micro instead of the big boy. But I've also wheeled big boy NASDAQ, big boy gold, big boy crude oil. I've wheeled all of those different things by selling puts until I'm assigned a future, then selling cover calls until they're called away. So that's another thing that I've evolved in, which is very different than what most traders on YouTube teach, because it's a lot more risky. It's a lot more risky when I'm selling at the money puts on something that I'm okay owning. I'd rather sell an at the money put on something and get paid to buy it than just buy the future outright and then start selling cover calls against it. So that's another thing that I've evolved doing is wheeling. But if people out there are watching, if you do not like seeing red on your screen, don't freaking try to wheel. Don't try to wheel, y'all, especially selling at the money puts. Now, if you're selling 16 delta puts or something like that, like further out of the money, higher probability profit, okay, then you'll probably be a little bit better. But I'm just telling you, you're going to have way more fluctuations in your account, and a lot of people can't stomach it. I can stomach fluctuations in my account. It doesn't like freak me out. It does upset me when there's massive fluctuations in my account, and it was my fault. Every time I've gotten in trouble, every time was because I went too big. Size matters. I don't care what she says, y'all. Size matters, especially when it comes to trading. I'm just telling y'all, it's fun making $5, $10, $15,000 a day. You know what's not fun? Seeing your account go down 30, 40, 50 grand in a day. And I've been there, done that several times over the past year and a half. And what I keep remembering is like the little angel in my ear, the good angel, saying, Joseph, don't trade too big. There's a trade tomorrow. There's a lot of time left. You don't have to make your entire monthly goal in a day. So that has been my biggest struggle is size. Size. If we trade small and trade often, like our friends at Tastytrade say, which I don't really follow a lot of Tastytrade methodologies. I don't like 20 delta strangles. That's a little too high risk for me. I like my shorts to start around a 7 delta, but I'm including some longs at around 12 to 16 delta. So I've got some potential upside if it moves against me in either direction. I'm not a huge fan of like Tastytrade's methodology, 45 DTE, close at 21, 20 delta strangles, blah, blah, blah. I'm sure it works for a lot of people. It doesn't work for me. I like to play further out of the money. I like to play further out of the money, start my shorts at around a 7-ish delta instead of a 20 delta. So I hope that answers your question. That was a very, very long answer about my evolution. And I'm happy to look at my accounts and,
Yeah, for sure. The last question I had, though, is so you went from 1-1-2s to ratio spreads, and then you started kind of putting ratio spreads on both sides, just like that strangles on steroids is what you call it. And that kind of helps really give you some protection because if the market goes down, then you have that call side. But outside of that, do you have any other hedging methods that you use to kind of protect all those short puts?
Well, I made a bunch of videos in May and early June about free long puts, free long puts, free long puts. The beautiful thing about put ratio spreads to hedge to the downside, most people don't talk about hedging to the upside. They want to talk about if the market falls 10% over the next month. I mean, NASDAQ has fallen over 10% in 2 weeks. And yes, it's hurt me. Why? Because I was too big. I was too big. Now I'm still up for the year, but I'm really frustrated with myself that over the past 2 weeks, I've lost about $40,000 to $50,000 of my account, which is around 10%. So guess what? If I had just been invested in NASDAQ, then I'd be down 10%. So like, it's basically the same thing, but I'm really upset with myself that I allowed myself to put myself in that position. But hedging is typically people worry about the downside than they worry to the upside. What's beautiful about put ratio spreads, whether you're doing the 1-1-2 that Mr. King and Igor and others teach online, whether you do just pure ratio spreads like 1x3, 1x4, even 1x2, 1x2 ratio spreads have much less risk because there's only one naked put instead of, two or more. What's really cool about that is once the short options that we sold either on the call side or the put side, and I've got a couple free long calls now that I've gotten over the past 2 weeks. I have some free long calls on NASDAQ. Now they're far out of the money, but I did some NASDAQ call ratio spreads, and I made so much on the short calls when the market fell to where they eroded in value. The options that I sold eroded in value tremendously fast to where I could then take off those short calls, or if on the put side, take off those short puts and leave the long put or long call on. What's beautiful about that is I got paid to buy that long put. I got paid to buy that long call on the upside. So the main way that I hedge now is just to leave the free long puts on that were a part of put ratio spreads after I take off the shorts, and leave some, if not all, of the free long calls on once I'm able to remove some of the short calls, take off that risk. It stinks to see a huge red position. Like, I don't like seeing, this long put that you've had for 61 days and still has 30 days left to go, it's down 85%. It's down $3,000. Like, that annoys me. It hurts my OCD. I do prefer seeing green on my screen and not red. But by leaving the free long options that I got paid to buy as a part of my ratio spreads, primarily on the put side, but also on the call side, that's the way that I hedge. The best way to hedge is to remove size, for one. And I did that today. I don't know if you saw on the Discord, but I posted in the Discord. I trimmed most of my positions by about a third today. Why? We have the FOMC tomorrow, Federal Reserve Open Market Committee, and Jerome Powell is speaking tomorrow afternoon after they say that they're going to hold interest rates steady, most likely, but they're probably going to hint at a rate cut in September and or November. I'm worried about that. I'm worried about earnings. We have a lot of earnings. Microsoft, Apple, Alphabet was last week, Facebook, Meta, whatever. I think we have a lot of earnings this week. That'll be volatility. So I removed about a third of my position sizing over the past 2 days. That's a hedge to me. By removing size, that's a hedge. But the true way to hedge is to buy something. Buy a put if you fear the downside, or buy a call. Maybe you've got some short calls and you're worried about your short calls being threatened. Buying a call. So that's a way to hedge to the upside. I'm not a huge fan of buying options. I'm just not. I'm not a huge fan of buying options. I probably need to get over it. Now, some people might say, JP, when you leave the free long puts on or the free long calls on after you remove the short options, you are paying something for that trade because you're giving up potential credit. If you were just to sell that long option back to the market, maybe it's worth $100. Maybe you bought it for $1,000 and now it's lost 90% of its value because the market went the opposite way, which is fine. So you are paying something for that, I guess you'd say. But for me, I just don't like buying options. I don't like buying. I like to sell and I like to collect premium. So that's something I still probably need to get over. I need to be like, you know what, JP? Buy a freaking put. You've collected $10,000 of premium selling options. Put $500 more towards a put. Maybe a 90-day out, 4 or 5 delta put on NQ or something like that. Spending a little bit of the credit that I've brought in to buy some protection. It's just like I insure my house. I'm living in a nice, beautiful house here in Huntsville, Alabama. I insure my house. Shit, I insure my phone. Why? Why do I spend $10 or $12 a month? I don't even know how much it is. I just pay it. I insure a $1,000 device. Shouldn't I insure a $500,000 account? Probably. So that's, to me, something I need to continue to work on. I struggle with the idea of paying for insurance for my portfolio, but boy, do I wish I had some on over the past 2 weeks.
Is there an ideal level that you look for? Like, if I have this many ratio spreads on, I should have this many long puts. Ideally, the free ones. But do you look for a ratio like that?
No, and what I forgot to say a few minutes ago was back in May and June, I was really big on building a wall of free long puts. You know what I did? Towards the end of June, I took them all off. I sold them back to the markets. I wish I'd have left some of them on. I just didn't like seeing all that red on my screen, even though I had made money by buying those puts. So I closed them all in June. You know, the market was going up, 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 and I closed them all in June. So really, what I should probably do is never, ever, ever get rid of a long option that I got paid to buy. Whether it's a long put to the downside, even if it's 3,000 points away on like the NASDAQ, that would be a lot on ES. Yeah. Let's say it's like 1,000 points away on ES, 20% away, or 4,000 points away on NASDAQ, which is about 20% move. Even if they're crazy far out of the money, I just need to leave them on. Because if we have a nice 5, 10, or 15% pullback, those might make a little bit of money. Yeah. The thing is, most of them will still expire worthless. Yeah. A vast majority of them will still expire worthless, but it will help smooth out my return curve. I could close some, once they make a little bit of money, I could take some off. The problem is over the past few weeks, I didn't have any on. Zero, because I took them all off in June, towards the end of June. I just thought the market was going to keep going up, up, up. I kind of wish I left about 10 or so of those on. So right now, I don't have any free long puts. I have a couple free long calls, but I'm working to build my free long puts up to give me that downside protection. And I'm going to start buying some hedges. Probably long-term, 120 to 180 days out, low delta, 3-ish delta, something like that. Very, very low probability of profit. And I'm just going to pretend like it's home insurance. I pay home insurance every month for my house. Why not pay a little bit of insurance to insure my portfolios? So, asking me about hedges is probably not the wisest thing to do because JP's crazy, y'all. I'm crazy. I trade big and I don't hedge a lot. I've made a ton of money when things went my way, but I've also given most, if not all, of my gains back multiple times over the past 2 years, and I'm getting freaking tired of it. I'm getting sick and tired of the roller coaster that I put myself in. You know what? My long-term, high probability trades have never failed me. It's when I went too big buying actual stocks, ETFs, or actual futures contracts and holding on, not using a stop loss, trading like an idiot, and it's killed me. So that's my strategy moving forward. Long-term, high probability trades, primarily put ratio spreads on NASDAQ, a little call ratio spreads mixed in just for some diversification. And I like double ratio spreads on gold, bonds, and crude oil. You're just kind of playing both sides of this market, staying very far out of the money and keeping my buying power in check so I don't go too crazy. So I've got some free capital available to take advantage of nice moves that go against my current positions. I can place new trades. Consistency and time in the market, to me, I think is better than timing the market, right? So many people think, I'm not going to invest until market pulls back. Okay, to what level? What percentage? Like when are you going to decide to buy? I'm going to tell you something that I don't think it's a bad thing to share, but I want to keep the details generic. I have a family member who is in his 70s. He's in his 70s. Never worked a day in his life. There's some mental stuff there or whatever. My grandfather, grandmother, my family, I need to keep this more generic. His parents knew that he would probably need support long term, and they invested for him. $100 here, $500 there, $1,000 there, whatever. Primarily high dividend stocks. My grandpa loved Alcoa, tobacco, because that was our family business. Our family business was stocking gas stations, right? So we had a family business that was a warehouse, and we sold candy bars, cigarettes, dip, all that kind of stuff. Whatever you could see at a gas station, our family used to sell, right? So my grandfather loved the tobacco stocks. He loved banks. Oh, he loved all the banks because they paid really good dividends. They were pretty stable. He even bought preferred shares and stuff. So long story short, I have a family member who's never earned a penny in his life. Okay, never earned a penny in his life. But because his parents invested and he invested, reinvesting those dividends, and he had a financial advisor who helped him, Austin, he's worth over $8 million today in the market alone. In the market
Awesome.
alone.
Yeah.
He's not selling options on futures. He's not day trading or scalping. Man, I wish I could figure out what the cost basis is of his investments. I'm telling you, dude, it's probably not 50 grand. I don't know. It depends on how much my grandfather would have saved or invested. I'm guessing it's not 100 grand.
Mm-hmm.
There's over $8 million in his account today. So going back to what I said 30 minutes ago, most people should not sell options on futures, should not try to day trade. Shit, most people should never try to day trade. Trust me. I'm great at it until I suck at it, right? I'll have 9 winning days in a row, and then I'll give it all back in one day like an idiot. Most people should just dollar cost average and save and invest into something like the S&P 500 SPY. I do feel like that we can have an edge. We can sell options, high probability options, bring in credit, even if we're wrong, can still make money. I do feel like that gives me an edge. I do feel like that's one reason why my IRAs are beating the S&P by 2 to 3 times what the S&P's earned this year. My main account isn't. My main account's not beating the S&P. Why? Because I was an idiot several times over the past 6 months. So I was making good money, but then I give it all back, make good money, give it all back. And I'm just so tired of that roller coaster. And I feel like I'm going to do so much better for myself and for my family if I stop thinking, I need to make $2,000, $3,000, $4,000, $5,000 a day day trading. No, let me have my $1,500 a day of daily theta just working. Some days will be down, like today. I'm down. I'm down right now. Nasdaq's off 1.2%. S&P's down 0.58%. I'm down a little over 1%. So kind of in between NASDAQ and S&P. It's not the end of the world. It sucks. I don't like being down 1% on a day. But you know what I can tell you is if I was actively trading, I'd be down a lot more. Did I answer your questions?
Yeah, that did. Yeah, I really appreciate it. And no, I agree because I kind of followed the same journey. And I think everybody does, where you kind of jump into the day trading world and you're like, this is so fun and fascinating. And then you're like, oh, wait, this does not work. So I mean, but I also love the process of, even though I'm like actively doing 112s, I still have money in SPY that like I'll never touch. It's been there for like 3 years, and that's money just it's there. And so, yeah, I think most people, like 99% of people, right, just invest in the S&P 500 and you'll do better than almost everyone else. But for those who like that, who like having an edge and do want to kind of put their money to work in a better way, I do agree that like if we do 112s or ratio spreads with like really high probability out of the money puts, then we could have a great win rate given our emotions are under control, right? And so that's something that I definitely want to work on. And I mean, I think we talked a lot about like theory, or you've discussed like theory and ideas. So I would really love if maybe like 5 minutes or so, 10 minutes, go over like your actual portfolio.
Yeah, man. You know what? I don't care if people can see my account numbers. I'm going to take off privacy. Like, I don't care. Y'all can see my account numbers, right? I don't care. Like, what are you going to do? Good luck hacking me, hackers. Good luck. I shouldn't say that, should I? No. So here's my accounts today, and this hurts. I'm down $6,000 right now. So that's a little over 1%. Well, my main market is NASDAQ, and it's down 1.33%. So like, this is not freaking me out right now. This is not freaking me out. And I'm really, really thankful that I have my buying power in check. I took off a lot of my positions. Right now I'm only using, oh shoot, you can't see this. Hold on. Stop sharing, new share. I want to show my, not P&L graph. Hold on a second. Capital requirements window. Let's see if I can do this real quick. Okay. Share screen window. I'm not familiar with this platform. Let's see here. Can I see?
I'll just clip this part out.
That's okay. It's real. Oh no, it's not letting me. Oh, here we go. Here we go. So here is my current buying power utilization, 66.5%, 60.5%. But look how much is in SGov. That's a treasury bond ETF, SPY. Bitcoin is very, very small. So if we take those out on futures, I'm using very, very little buying power. Very, very, very little buying power. And I have a lot of dry powder. I have a lot of dry powder that I could use. So I just wanted to show that real quick. Let me close that window and let's go back to sharing Tastytrade. So, looking at some of my strategies, I really like how Tastytrade lets us view the potential profit and loss graph, profit and loss charts. The only problem is I can't easily do that kind of back and forth, but I'm playing both sides of the markets. Like, let me just look at my trading account and sort it by days to expiration. There we go. Let's just take a look at all my positions real quick in my main trading account. So, Austin, I'm jealous of you, man. You're saying you've got some share SPYs that you bought 3 years ago?
Yeah.
That's amazing. I just started buying SPY shares again a couple weeks ago. They're currently down 2%. Not a big deal, right? Not a big deal, down 1.9%. I'm adding 1 or 2 shares a week, and I'm selling covered strangles. I'm selling covered strangles against my SPY shares. So right now, my covered strangle is basically a break even, right? Basically a break even. Am I okay buying 100 more shares at 535 if the market falls? Yes, I'm okay averaging into a SPY position. Now, once I have around 300 shares, because I like selling options on futures, I'm going to have to be very careful on selling puts, but I can keep selling calls. But basically, I'm selling covered strangles on SPY, bringing in a couple $100 a week. This is $311 that I brought in, bringing in a couple $100 a week. Last week, I closed my cover strangle for a small loss of around $50, and then I sold this one for $311. Right? I sold this one. Why? The put was getting very, very close to in the money. It was a 545 put. If I had held it, it expired yesterday, I would have been okay. It expired yesterday, and SPY closed over 545 yesterday. Right now, we're trading it just under 541. But I decided to roll it last week, move my strikes further out. So I'm wheeling SPY, but I'm not going to let my calls call them away. I'm jealous of you, man. I wish I had some SPY shares that I bought 3 years ago. I don't. I just started buying these a couple weeks ago. So I'm doing the covered strangle strategy on SPY, but I will not let my shares get called away. So let's say we have a huge rally in the next 3 days. Not likely. We're not going to go up 3% in the next 3 days. But let's say these calls got challenged. My call got challenged. I would just close it for a loss and then sell another for the next week and just move on. I'm wheeling the micro NASDAQ. I sold this put on micro NASDAQ at the money, 19.3 yesterday. I brought in $582. Well, look, we're trading at 18.9 right now. Holy smokes, that's $400. I wanted to own some micro NASDAQ. I wanted to own some micro NASDAQ so I can have some more long deltas and be a little bit more directional. And I like the micros, the micro NASDAQ or the micro ES or the micro gold. Keep in mind, micro gold options do not assign to the future. They expire to cash, so it's really hard to wheel a micro gold. And Tastytrade doesn't even sell micro gold options. But anyways, if I had just bought, let's do some quick math. If I had just bought micro NASDAQ yesterday when it was trading at 19.3, let's take a quick look at the chart. Let's change it to like a 5-minute chart. Hold on a second. 5-minute chart. Bada bing, bada boom. Here we go, baby. There we go. And I don't care about seeing this so big. Oh no. I just want to move this down a little and move this down a little. Oh, come on, Tastytrade. Tastytrade's charting kind of sucks.
Yeah.
But I don't want to switch to TradingView. So yesterday, see, I mean, we were trading around 19.3. We had a huge dip and then a nice V-shaped recovery. We sold off after hours. Nice pop pre-market. Boom. Gone straight down since the open, right? The market opened here at 8:30 Central. Little poppity pop. We're down 350 points, right? No, almost 400 points, almost, right? Down 400 points in the past 2 hours, okay? If I had just bought NASDAQ here, instead of selling a 19.3 put, 19.3, I will be down $360. $360 times 2 is $720. If I had just bought a NASDAQ future, I would be now $720 right now. Micro NASDAQ. However, because I brought in premium with a higher probability of profit, I'm only down $390. See, this is why I like selling options. Even though I'm wrong, In this case, I'm not making money. I'm down $390 right this millisecond. I'm still not worried about this strike. And I'm okay taking assignment here. And then I will start selling covered calls against it. But because I sold an option to start this position, I'm only down 390 instead of 720. So hopefully that makes sense. So I'm wheeling micro NASDAQ. I got some double ratio spreads. What does this look like? Let's take a look at the analysis. This is like, I'm not going to do every single one of these. Let's just look at a crude oil double ratio spread real quick. Now, crude oil has fallen a lot since I put these trades on. Okay. Crude oil, if we take a look at the chart on crude oil real quick, let's take a look at the daily chart or maybe the 4-hour chart. Let's take a look at the 4-hour sorry. Austin, I cuss a little. And if that upsets your fans, honestly, I'm not sorry. I'm not. I cuss a little, y'all. I love Jesus, but I also cuss a little. So if we look, gold has fallen a ton over the past 2-3 weeks, right? This was 3 weeks ago, right? Gold was trading at 82.54. Now it's at 73.80. Oh my gosh, right? Crude oil has fallen a bunch over the past several weeks. Well, I opened this position 8 days ago. So what was 8 days ago? Let's go back to the chart, change it to daily real quick. 1, 2, 3, 4, 5, 6, 7, 8. So we were trading around 78-ish, 77-ish, something like that when I put this trade on, 78-ish. Now we're at 73.85. This doesn't look so bad zoomed out, but when you zoom in, I mean, this is just a straight move down all month, all July. Well, because I'm also selling on the call side, look, my call side is profitable. The problem is the put side is way less profitable or losing more money. So my overall position is down $840. $840 right this second. I brought in $2,400, but see, there's still an 86% probability profit. And if I go back to the analysis tab, just to show you all why I love the double ratio spreads, instead of just a strangle, see how if the market continues to fall, and this is at expiration, okay, this is at expiration, this graph is for, but let's say the market continues to fall, I could potentially make even more money. Now, there's still unlimited risk to the downside because I have nakedness. I've got 5 naked puts. I've got 5 naked calls, right? But I really prefer this type of structure instead of just a normal strangle. You know, if I go to like, say, I like 60 to 90 days. So I would probably do something around 79 days. I like to start my shorts at around a 7 delta. So if I were to do a 7 delta, that's 58. Right now we're trading at 73. And then 7 delta on the put side, that would bring in about almost $400. What's a 7 delta on the call side? 7 delta. No, that's not delta. Hold on. 7 delta is up here, you silly goose. That's what I tell my kids when they're annoying me. All right, delete the leg. I was looking at the wrong thing. 7 delta is selling for about $290. So in this case, crude oil has some put skew. The fear is to the downside. The short put is able to collect more premium than a short call. But what does this look like on the analysis tab? What does this look like? Why is this not working? Curve. And then let's look at just this order. See, if I look at just this order, see how it's just a flat line compared to my double ratio spreads. I have a flat line, but a potential to make a little bit more if the market rallies, or a potential to make a little bit more if the market falls. They're basically the same trade. This 2x7 double ratio spread on crude oil is basically a 5x5 short strangle. But because I have some long options here, now here's another thing that I could do if I was really risky. You know what I could do? I could close one or both of these long puts right now. I could lock in this gain of $590. However, that would mean all 7 of my short puts are naked, and that would just tremendously add a ton of risk to the trade. But that's something I have done, man. I've trimmed some or all of my long options that were part of my double ratio spreads or even just normal ratio spreads. If I still like the strike, I mean, look, dude, my short here still has an 86% probability of profit. Right, still an 86% probability of profit. So that's something else that I could do to potentially profit more from this trade is I could close some of these longs. But if I did that, if I closed these longs, that would just add a ton of risk to my trade. So I'm trying to not overtrade. I'm trying to just leave these on. So I put this on 8 days ago. I've added to it once. So now it's at basically max size. I really don't need to add more to this. I just need to let the probabilities play out. There's an 86% probability of profit. And going back to the analysis tab, we're still in great shape. If we expired here, then I would just keep the $2,400 of credit that I brought in to sell this trade. So that's a double ratio spread on crude oil. NASDAQ, put ratio spreads. This has been on for 43 days. It's not really up 53%. I've sold more, closed some. I actively trade my put ratio spreads. This is my current position. So I'm long 1, 19,000, which is in the money, and I'm short 5, 17.2. This overall trade has a 92% probability of profit. This overall trade that I currently have on, again, I've traded in and out of all my put ratio spreads, especially if they've been open for a month and a half. I've sold puts on down days, then I've taken some off on up days. So I actively kind of manage my ratio spreads. But I brought in $5,800 for this trade. What does the analysis look like on this ratio spread? Let's look at just this ratio spread. Zoom out, click the little green thingy or white thingy. Here we go, baby. So here we are. We're trading just in the money, past my long put. If we go all the way down to my short puts, holy snikes. My short puts are around here, right? What is it, 17,250, right around here. The max potential profit of this trade, assuming 52 days from now in July, no, that's not right. On September 20th, we close at exactly 17,250. This trade would make 40 grand. Now, if it fell to 17,250 today, my P&L theoretically would be minus 20 grand. Like, that would suck if it happened today, but it's not likely to happen today. So the P&L zero line, the P&L zero is the kind of the orange line. I'm really happy with this trade. I'm really, really happy with this trade, this 1x5 put ratio spread. I'm not going to go through all of these, but I've got double ratio spreads on bonds that started 8 days ago. Double ratio spread on gold started 8 days ago. Those are profitable. The crude oil one, not profitable, right? They're probably washing each other out at this time. Fine. All I really care about is the probabilities of profit. Do I have a high probability of profit? If I have a high probability of profit, I'm not stressing the fact that I'm down $7,700 a day. Shit, that got down a lot more since I started sharing my screen. But anyways, I'm down $7,500. You know, why? Because the markets are down. The markets that I trade are down. Equity markets are down. Crude oil is down. So what if I shrink all these probabilities of profit? If I'm seeing 70% or higher, 80% or higher, 90% or higher, I'm not freaking out when I see my probabilities of profit are so high. Okay. So, you know, let's compare a 112. Now, most people don't do 112s on the ES, NASDAQ, they do ES. Like, this is why I evolved to pure ratio spreads. And dude, the 112 is an amazing trade. And I like 111s. That's a nice way to kind of hedge. It's not a hedge because, you know, there's still risk to the downside. But I like 222, 333, 444, or 221, 331. Like, there's lots of different ways that you can buy put debit spreads, pay for it by selling further out of the money short options. But let's compare like a traditional 90-day expiration 112 trade. Okay, which is an amazing trade, by the way. Most people like to start their two shorts at around a 5 delta. When I was doing 112s, did 7 to 10 delta, especially on the equity markets because I was comfortable with it. But let's just look at a 5 delta, starting there with the two shorts, and then starting the long at around a 25 to 30 delta. I believe most 112 traders start around 25 delta and make it 25 to 50 points wide. Let me do this as 1. So here we go. This needs to be 2. Hold on. All right. So this is a 112 trade. This is a 112 trade. Brings in about $1,100, almost $1,200. This 99.5% probability of profit. That is sexy as hell. Max profit potential, $3,600. Okay. If we take a look at the analysis curve, what does this trade look like? Let me zoom out. And then here we go. So here we go. If the market just goes up, all I would make is this just under $1,200, right? If the market falls, though, I could potentially make at expiration $3,600. Break even is all the way down here at around a 44.60. 44.63 will be my break even. Okay. Beautiful trade. Beautiful trade. But look, the T0 line is still pretty damn steep. If we were to fall 100 points, it's still pretty steep, but beautiful trade. Okay. What I don't love is how it's capped here. Let me do a similar trade. Let me try to remember this. 1100. I mean, this is a really nice trade. That's almost 20% return on margin. But let me try to do a similar trade that Joseph would do. I like to start my shorts at around a 7 delta, somewhere around here. Oh, come on, click and drag. Here we go. Somewhere around here. 3 shorts. Here's the problem with the way that I trade my ratio spreads. My long put is going to be further out of the money. It's not going to be a 30 delta or 25 delta. It's going to be more like probably a 16-ish delta, 12 to 16 delta. All right, this is a very similar trade. Let me try to make it match. This is about, oh crap, this is wrong. So the buying power on this trade, if I didn't have any other NASDAQ positions on, would be a lot higher than this. Why is it only 1,500? Because I have other positions on, and that's what's beautiful about futures and options on futures is they use span margin. It takes into account other trades. So in this case, I'm bringing in about the same credit, but look at the max potential profit, $16,000. Look at this, baby. Look at this, baby. This beautiful profit tip again at expiration. If the market fell, if the S&P 500 fell, 200 points over the next week. Now this is today, so I'd have to change this to daily view. So if I go out to further out in time, see how it's smoothing out the T0 line as I go further out in time. Let's say the market crashed today and we went down 5%, 250 points. Shoot, this position could be down $1,500, right? $1,500, that sucks. But what I like is this beautiful, huge profit tent. Similar credit, similar probabilities of profit, similar buying power. This is why I prefer 1/3 ratio spreads, but there's less likelihood that I'll hit this. What was the 25 delta? 25 delta would have been about 52.25. If I were to move this up to 52.25 to have the same long put, come on, baby, 52.25. Like, damn it, why won't this not work? Here we go. 5,200. See, look, now I'm in a debit. Now I'm in a debit, even with my short puts here. So I'd have to move this up slightly to bring in a similar credit. Okay, look, very similar. Oh man, this is actually a nice trade. Am I about to put this on? But I don't trade ES. I might primarily trade NASDAQ. All right, look, dude. Similar credit, similar, slightly lower pop. This buying power is wrong. It's because I have other futures on. Look, break even, similar, my man. Yep. So a 112, starting with the one long put at 52.25, brought in about $1,100 with like $3,500 in max profit potential. This 1/3, and the break even was around 46 something. So this moved my break even up slightly. Max profit though of around 3,500. This ratio spread tent, max profit potential of around 18,000. Not likely. We would have to close at exactly this strike. But what if we closed around here? Or what if we closed past my short strikes? See my P&L expected? Much higher than a 112. And again, I'm not knocking the 112 trades. I just prefer 1/3 ratio spreads, similar credit, similar probabilities of profit, but similar buying power, but much higher potential profit at expiration. And I know people keep saying, JP, this is only at expiration. Your beautiful curve's only at expiration. Right? If I look at just my NASDAQ trades here, my NQZ4 trades, zoom out, click little white thingy over here. This is at expiration. Wait, why does this look like this? Okay. Because I have some calls. And we're trading way down here. Hold on. Where are we trading? Oh my God, we're trading way down here. Holy smokes, right here. So I've brought in $15,000 of credit, all of these various positions, puts and calls. And if the market goes down, see, I could potentially make $100,000 if I was holding all of these positions at expiration. Not likely. It's not likely at all. In fact, I rarely expect to ever hit the tent. The main reason I like having some long options instead of just short naked puts is if I'm wrong, it helps offset me being wrong. And if I had plenty of buying power available, you know what I could do right now? I'm not going to do it because JP is trying to be a better trader. He's trying not to trade too big. He's trying not to be a degenerate dumbass. Okay. But you know what I could do right now, Austin? I could close this long put right now and lock in a $9,200 gain. Leave my nakeds on. Yes, they're down 6,000. They're down 6,000, but they have an 87% probability of profit. I could do that, but I'm not. I'm not going to do that. Let me refresh my buying power. I'm not gonna do that, but I could trim some of these long options for a profit, leaving some, if not all of my nakeds on. It increases my risk, but dude, 86% probability of profit. I'll take that every day. So double ratio spreads on gold, bonds, crude oil, and I've got some NASDAQ put ratio spreads, which I trimmed today. I trimmed them. I don't know if you saw in the Discord, because I know you're in the Discord too, but I trimmed most of my put ratio spreads on NASDAQ by about 25 to 35% this morning. I'm glad that I did, because NASDAQ's down 1.39% right this second. Okay. But notice I've got some on the call side. I've been doing well on the call side the past couple of weeks, and I will take this off sooner rather than later. I've got a free long call up here, right here, baby. Free long call. There's only a 2% probability of profit, but hell, I got paid to buy this call because I sold 3 or more short calls to more than pay for it, and I took it off. This trade's been open for 39 days. So you know what? I could sell this back to the market and bring in $145 back into my account. But I kind of just want to stockpile all of my free long options. Why? Why get rid of it? I made more on the short calls to more than pay for this long call. I'm just going to leave it on. What I wish that I still had was some of the free long puts that I had accumulated in May and June before this 10% sell-off in NASDAQ. So, dude, I don't know if I'm answering your questions or not.
No, it was awesome.
These are all my positions. Hopefully that helps. What am I doing in my IRAs, my smaller accounts? I'm doing put ratio spreads on MES, micro ES put ratio spreads. I took this one off today to remove some risk. I'm also wheeling micro ES, so I'm down pretty substantially. But hey, at least I made some money on my cover calls. That's okay. I could close these right now and sell some more cover calls for next week. I'm just going to let these ride through tomorrow, let them expire, and I'll sell more cover calls. And my wife's IRA, another reason why I love Tastytrade, is she allows me to trade her account. We literally filled out one form and we emailed it into Tastytrade, and like 2 hours later, it was showing in my accounts. So I can actively trade or monitor my wife's accounts. So in her case, wheeling micro ES, I'm not long any futures yet. I've just sold this put. It's down. You know, if I had just bought an MES future at 5,500, whenever I'm wheeling something, I always sell it at the money. I sell it at whatever the strike is. So when I sold this put 6 days ago, ES was probably trading right around 5,500. I can confirm that by looking at the chart. 1, 2, 3, 4, 5, 6. Boom. Oh no, it's 5,600. Maybe was it this day? I don't know. But anyways, I typically, when I'm wheeling something, sell at the money. So for example, if I didn't have anything on, I would go 7 days out and sell this put right here. Bring in $270, 68% probability of profit. It's taking $2,800 of buying power. I can sell this put right now, which by the way, because this is in an IRA, this is twice the buying power versus if it was in my trading account. Boom. See, my trading account, I could sell the same put for only $1,400, but in my wife's IRA, it's twice. So if I had just bought an MES future at 5,500 and we're down, 43 points? What's 43 times 5? 43 times 5, 215. I would be down $215 if I had just bought an MES future at the time that I sold this put. Instead, I'm only down 166. By selling options and bringing in premium, it's increasing my probabilities of profit. But that's what I'm doing. And my wife's IRA is selling put ratio spreads in the micro ES. I'm starting to build up a long-term position in JEPQ. JEPQ has around a 9% dividend. It beats the S&P 500 since inception if dividends were reinvested. So I'm slowly building up a JEPQ position, just like I'm slowly in my main account building up a SPY position. So, dude, did I show you what you wanted to see?
Yeah, that's awesome. I think people are going to learn a lot from this, not only learning like the theory, but also like seeing it in action. And so, yeah, with that, I know you do a lot, and you just mentioned you don't do YouTube as much, but I still know you post because I like to watch your
Yeah.
videos. But where could people go to find out more about you? And I'll make sure to put all these links below.
Yeah, man. So I'm on YouTube. It's Trade with Joseph. My handle is at Joseph D. Puckett. So youtube.com/Joseph D. Puckett. I post about once or so a week. I was posting every day for a while. But dude, I've realized I don't really want to be a YouTube personality or a finance YouTuber or whatever. It's just not worth the stress. And really, I feel like I was trading much bigger. I know what I said earlier by having the Trade with Joseph Discord, which is now free. So check that out at tradewithjoseph.com. Free Discord. There's no charge. Tradewithjoseph.com. We've got about 600 members in there, and I want to see it keep growing and being more active. I'm learning. We've got some traders in the group that have been trading for 20, 30, 40 years. I'm watching what they're doing. I'm thinking, okay, they've survived 3 decades doing this shit. I should probably learn something for them. So I'm learning. So please check us out. It's free. There's no cost. Tradewithjoseph.com. There's a little link there to join the free Discord. YouTube.com/Joseph D. Puckett. It's Trade with Joseph. But man, I don't want to be a YouTuber or whatever. And I honestly feel like because I was making videos every day and sharing my success, that caused me to overtrade. Man, remember back in April, March, February, when I was making $5,000, $10,000, $15,000 days? You can go back and watch my videos. I was killing it until the third week of April 2024, when we had about an 8% sell-off in NASDAQ. I had about 10 NASDAQ futures at the high. I added 5 on Tuesday. I added 5 on Wednesday. I added 5 on Thursday. I ended up with 33 NASDAQ futures. Now, if I had held that position for literally 1 week, I would have been okay. However, if the market didn't go back up in my favor, like 500 or 600 points the next week, if the next 500 or 600 points were down, it would have wiped out my account. And that sickens me. It sickens me to think about it. So I feel like not posting as frequently on YouTube is not having me be stressed about, hey, look how great I am. Look at my green. Look at all this green on the screen, baby. Stay green. Happy trading. Stay green. I made $10,000 today. No, I'm not going to do that anymore. Well, number one, I'm not trading that size ever again. Ever again. Man, this is my money. This is my wife's money. This is my kids' money. I can't be gambling. I can't be buying 15, 20 NASDAQ futures and scalping in and out like crazy like I was doing. I was making hundreds of trades a week, man. Hundreds of trades a week. And I was killing it until I gave it all back. If I could go back in time and say, Joseph, please just stick with long-term high probability trades. My accounts over the past 4 years since I've been trading, my accounts would easily be double the size they are now. Double. So, word to the wise, most people just save and invest into a passive ETF like SPY. Dude, most hedge funds can't beat SPY more than 2 years in a row. Like they might beat them 1 year in a row. Some will beat them 2 years in a row. It's like 5% or something of hedge funds can beat the S&P 500 returns over a 3 or more year period. Less than 5%, I believe, is the last stat that I heard. Most of y'all watching this video should not be selling options, should not be trading futures. Most of y'all watching this video should be saving, investing as much as you can into something like the SPY, S&P 500, just dollar cost average, like my family member. His parents saved and invested for him 70 years ago, 60 years ago, 50 years ago, 40 years ago. They've been dead for 20 years, almost 2006. Almost 20 years since my grandma died. My grandpa passed away first, but my grandma died in 2006. Since then, his accounts have doubled since then. And he's just in long-term investments. A lot of high dividend stocks. They really still like high dividend stocks like Alcoa and a couple other high dividend stocks. And preferred shares. He really likes preferred shares. Preferred shares have less fluctuation, but higher dividends. They also get more protection in the event of a bankruptcy, whatever, blah, blah, blah. You know what? My family member who has never made $1 in his life is now worth over $8 million. You know what he's never done? He's never sold an option.
Yeah.
I love selling options. And man, I'm going to be doing this until I'm dead. Seriously, I freaking love it. My problem is I get sucked in. Like I'm looking at this NASDAQ move right now. MACD on the 5-minute is about to have a positive cross. We've sold off from 324 to 920. We've sold off 400 points in the past 3 hours. We're about to have a positive MACD cross. Old JP, I'm talking old JP from 3 months ago, 10 NASDAQ futures. I'm buying them, baby. I'm buying those 10 NASDAQ futures, just looking for a 15 to 20 point move. I'm not looking for a 100-point move. I'm not looking to get back to 300 points higher from where we were. That's old JP. You know what? Last week I was on vacation. I didn't actively trade at all. Yes, we had some wild swings last week, but I ended up the week really good. You know why? Because I didn't touch my damn accounts. I didn't touch them.
Yeah.
I just let the long-term high probability trades do their thing. So that's my biggest challenge is I'm addicted to the markets, man. I freaking love it. I love watching the markets. I love trading. The biggest challenge that I have is getting up and walking away.
Yeah.
When I typically don't do much at all, if I'm just letting my positions work, it's fine.
Mm-hmm.
It's when I'm more active that I dig a hole for myself. And it's embarrassing to admit that. But I bet I'm not the only person watching this video or whatever. I bet I'm not the only person that can ever admit to going too big.
Yeah.
I love trading. I'm going to be doing this stuff until I die. But what I want to get to a point of is 30 minutes a week, not even 30 minutes a day. I want to spend about 30 minutes a week looking at all my positions. Do I need to make any adjustments? Do I need to trim anything? Do I have any short puts as part of the ratio spreads that are up 80, 85% or so, and I can take those off and leave the long options on, whether they're puts or calls? 30 to 60 minutes a week is my new goal. Instead of trading 4 or 5, 6 hours a day, what if I was just trading 4 hours a month?
Mm-hmm.
That's my new goal.
All right. Well, thank you so much for being on here, Joseph. You shared a lot, and I'm so excited to release this video because I think people will learn a lot from it. Yeah, I'll make sure to put all those links down below to his YouTube, to his Discord. Really join it. It's very active in there. I love just reading it. And so, yeah, thank you once again, and thanks for being here.